Welcome to TheoTrade. This is Don Kaufman. It's September 26, 2018. You are watching the Theo Night video. With moments left inside of today's trading session, the S&Ps are down 10. The Fed cometh, and I'll tell you what, they changed one of the very key areas of their policy in terms of the statement that was made by the Fed. Well, first of all, of course, they raised rates. Everybody expected them to raise rates. That was absolutely, unequivocally no surprise whatsoever. But the statement no longer says that the monetary policy will be accommodative. All right, it took a while, but that actually sparked some sell-side activity in the S&Ps. And to be very specific, okay, this is not a broad-based sell-off amongst markets. If you take a look right here in the S&P 100. Now, allow me to kind of highlight this. It just froze the screen for a second. There's the S&P 100. Do you see the advanced decline line? Okay, not exactly hideous, is it? This is not, again, a broad-based market sell-off. This is very, very specific to the sector that I've been talking about day in and day out. I mean, literally ad nauseum at this point, and that happens to be none other than the financials. The financials are really what got whacked back inside of today's trading session. Now, from last week, and this is last Wednesday, the explosion to the upside to right now, this may have been one last hurrah. The big question mark kind of from here on out, and this is, the big question mark is the big $1 million question. If this sell-side activity occurs, there's the closing bell. If the sell-side activity continues, okay, and occurs in even greater amounts in the days to come, how bad will the damage be to the S&Ps? And more importantly, will we see correlation kind of kick in? My opinion, and strictly from an opinion standpoint, the answer is absolutely. The sell-side activity, okay, that kind of permeated late in today's trading session, people, what you have to recognize is this got real. Look at some of the contract size that was flying through here. That is offloading an absolute monstrosity of risk. Heavy contract size in the S&P, heavy, would be north of about 5,000 contracts per minute. Okay, now just to quantify some of the sell side activity, this is a 1 day, 1 minute. Right there is 5,000 contracts. We're doing north on most of these minutes here of 10,000 contracts. This is all hands on deck. We stop short at 29.10. Nevertheless, okay, we may see some follow through here, not only in the after hours, but continued into the evening. And later in this trading week, both Thursday and Friday, again, I would expect or anticipate some more sell-side activity, if you will, proliferation of what we saw inside specifically of these financials. Now, a couple of trade ideas for you. First of all, SPX. Let me zoom out for just a moment inside of the SPX because I want to give you orientation of where we are on the week in terms of expected move. Now, for those of you that kind of watch this and watch some of the weekend videos, this is the expected move for the week. The downside of the expected move is somewhere right in the neighborhood of about 28.96. Well, earlier in today's trading session, okay, and many of you probably caught this if you were live in the TheoTrade room, we actually laid a number of butterflies directly into this 28.95 level. All right, that's just buy, okay, and we're going to cruise down to butterfly for a moment. The butterflies are currently trading at 30 cents. We were purchasing them effectively at 15 and 20 cents. Now, would I suggest going out right this moment and running out to buy butterflies? Absolutely not. Okay, this butterfly, we may even be considering closing it later tomorrow if the butterfly expands to upwards anywhere from 50 to 60 cents. Yeah, it's a $5 wide butterfly, but people, I've got such a negligible amount of risk in this butterfly. All I'm trying to do, okay, is to kind of be right on the edge of this expected move. As we've seen in previous trading weeks, Okay, there's the edge of an expected move kind of hit. This is just shy of the edge of the expected move. In the previous week, there's the edge of expected move, the edge of an expected move. Okay, why not trade to the edge of the expected move? And I'm here on Wednesday, and I'm still capable of trading an expected move edge for Friday. I'd say that's pretty good and worth the risk at 15 to 20 cents in that particular trade. All right. Switching gears for just, let us discuss right now a little bit of intraday trade. Now, it's been a while since we've talked about some intraday trade because, quite frankly, we just haven't had a tremendous amount of volatility in some of the recent trading sessions. First of all, one thing that is notable, okay, far be it for me to point out a little bit of a short-term trend, but there looks like some sell-side activity here, specifically in the spiders. Okay, today we put on a trade. And I'm going to come right back to the intraday chart here. We put on a trade after the initial FOMC announcement. Now, just to kind of mark up on your screen over here, the initial FOMC announcement was right in this neighborhood. We executed into a bearish position right in this neighborhood here. Okay, markets were still upticking. Now, to display this trade effectively to you, the trade was placed in the spiders, okay? And we went out and we purchased puts that literally expire, well, today, okay? Here are the puts that we happened to purchase. They're the 292 puts. Obviously, I no longer have a position in them. We're out of that particular position. Here, okay, happens to be the effective trade. And I want to display something because the marketplace gave us some pretty good hints today about execution of this trade. The exact times of the executions were both 11:04 and 11:14. Both of these puts, okay, happen to be purchased for 40 cents. In fact, there's a little bit of size behind this one. It's the only thing I'm not showing you in here is contract size. Nevertheless, we are capable of exiting these puts for $2.20 and $2.30 respectively. Now, at 11:04, what did we see inside of the marketplace? Okay, if you take a look back at the S&P futures, right, and you kind of zoom in to this area here of 11:04, you really don't see effectively anything in terms of the chart. No, didn't have that much to do. It did not have much to do with the S&P futures. It had everything to do, okay, with the volatility, and specifically the volatility futures, right? The marketplace was rallying after the FOMC announcement. Volatility refused to back off. It's a signal that there's more risk to come. So the assumption was a very simple one. There'll be more sell-side activity or some sell-side activity after the 11:30 release. And when I say the 11:30 release, then we're actually talking about the release of course, Powell's speech, which came right in this neighborhood here, right at 11:30. And that's really when some sell-side activity did, in fact, start to progress, specifically when he was done talking. So in this particular circumstance, again, better to be a little bit early in that trade rather than, this was not a trade about trying to time markets, okay? And it was a signal specifically from the volatility futures not backing down, meaning that risk was still very much in play. Again, we'll kind of reiterate a few of the points that we've made in kind of today's trading session. Again, we see the S&P sell off, but they really sold off on the back specifically of these financials. Nothing more, nothing less. It's the financials that took the brunt of it. We expect, okay, broader base sell side activity in the days to come. If you want to get really specific, I would watch the monsters of tech. They did start to fall in correlation with the marketplace. Again, there was just not enough time effectively left on the clock today to see this sell side activity really start to spread to other products. Energy. Let's go over to energy for just a moment. Energy, which has been incredibly strong, finally, okay, has come off a little bit. For those of you, if you're in an oil position with us, okay, happens to be a bearish oil position, that, okay, once again, could be a turning point inside of oil. With all of this effectively going on, as we spoke a moment ago, I would expect the bottom side of the expected move to get hit, okay, as we progress through this week. I would also anticipate a little bit more volatility, obviously, on the Thursday or Friday trading session, as many of the traders kind of work out a little bit of their frustrations behind this kind of Fed policy change. With that, I want to thank everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.